put it out there so it looks good. Okay, Tim Dodge says start over. All right. Hold on. All right, there we go. How you doing, friends? This is the final hour of Expiration. This is season 2, episode 20. And today we're going to talk about gamma hedging your position. Now, what we do, nothing happens. What does that mean? I want this sound as a ringtone. Oh, all right. Okay, so everything's good now. Tell me if everything's good. We'll wait for you. I'm waiting. Tell me, yes, everything sounds good. Fine now. Thank you, Tim. All right, let's go back to the roll call and thank all these wonderful people. Here we have Richard Huber. How you doing? Is here. Nice to see you. Jay Hen, yes. And Philip, how you doing? And Tim Dodge is here. Tell us that there was a bad echo. Nino, nice to see you here. Max is here. All right, and let's see. We'll go on to Frederick. How you doing, Frederick? And Eugene, nice to see you here. And Jody, nice to have you here. Okay, on and on. Lena, yes, the 30-minute Nirvana. Okay. There we go. We're down to all the last people. Thank you very much. All right, cool. All of these comments. All right, I'm done with that. Well, I can't watch the chat and do everything all at once. One guy here. I don't have producers sitting in the background. All right, so what we're talking about is gamma hedging. Gamma hedging your SPX trade. And it's really cool because with the SPX, that's the big index. We do 0 DTE by doing an out-of-the-money butterfly. And you saw it before, even though you couldn't hear what the hell I was saying. And with any butterfly, our butterflies, they have good risk to reward because we put them out of the money, usually about a 1 to 9 risk to reward, as you saw. And we'll bring it here. So here's the out-of-the-money butterfly, pretty cool trade. The problem is that we have that risk, and let's say that you have the situation where you can't be in front of the trade. Now, I know there's probably at least 15-20% of our members that are actually working jobs and still trying to trade. So what do they do if they can't be in front of the trade? They need to hedge their risks. So maybe they're in a trade, they've got some good profit going, maybe they've gotten $200, $300, $400 of profit, and then they have to leave. Now, they have a couple of choices. This would be my first choice. My first choice would be just take the profit and then be done with it. You're good. You made $300, right? But no, some people want to stick with it and be able to put themselves in a position to potentially make that full $3,000 that was available in this trade. And so one way that you could do, or let's say that there's another situation where you felt like price had a potential of just dropping off a cliff. You're in that trade, you've got some profit, and you want to protect or hedge your position. Now, an easy way to hedge your position is to gamma risk or delta hedging, similar. Now, gamma is the sensitivity of price or sensitivity of the value of your option to price movement, right? So if price moves a little bit and the gamma hedge is high, you could lose a lot of money in your trade. And that's very typical when you're in a butterfly or an iron condor and you have that bulbous type profit curve. You're on the edge of it and has a big steep edge, right? So that the tangent to that is actually your gamma risk. Well, you can protect that edge by kind of flattening it out or even making it point the other way. And a typical way that you might do that is by shorting some SPY stock. But being 0 DTE and the last day of expiration, you don't want to short any stock. You could be exposed to early assignment on that, and you don't want that. So what you do is you create a synthetic short, and that's what I was showing before. And you do it with the XSP, which is 1/10 the size of the SPX. It would be like creating a synthetic short with the XSP would be like shorting 100 shares of SPY. Yeah, that's right. That's my producer dummy. That's Bob. He's no longer Bitcoin Bob. I took his hat off. Now he's wearing a 0 DTE shirt, as you see. Oh, that was Jay Hen calling me? Thank you. Thank you very much. You know, I don't take any phone calls while I'm online. I'll look at it and I'll say, why the hell are they calling me? All right. So I've got my fly here, and I want to protect. Let's say that, like earlier today, I'm sitting right here on the edge and I have profit and I want to protect from the downside. Well, I could put on this thing called the gamma hedge, which is nothing more than, if you see that top red line there. Let me move this out of the way. So the top red line here is the definition for the synthetic short. And what you're seeing is a call and a put, same expiration, same strike. The call is short, and then the put is long. When you put that combination together, you create what is essentially a short stock. So if I put that on, this is what happens to the strategy. So you can see that looks pretty good. I put the strategy on, and I get this beautiful hedged position. So if price goes down, it's no problem. As a matter of fact, had I put on just this short earlier, then instead of being down the cost of this fly, which was about $290, I'd actually be up about $250. So that's quite a swing, more than a $500 swing. So, and I did that simply by putting on this synthetic short, which is in effect what we call a gamma hedge, because what it did was it eliminated the risk that I had earlier. Now, earlier when I put this on, by putting this on, caused that purple line to go straight across. When it just went straight across from here all the way over to here, right? But now that now the time has come near to the end of the day, the premium is decaying. It's coming towards the right towards the line at expiration, which is that cyan line, and so it's starting to take the shape of the strategy at expiration. So that's a gamma hedge. Now, what I did earlier, just to prove a point when I was putting this on with the group, was that I also put on a synthetic long. And so this is what happened to the strategy. I actually created a strategy because I had a little bit of profit, enough to cover the risk of the debit that was in my fly, totally covered it. Now you can see that the risk of my fly now is practically zero. Well, it's actually like minus $49. But it has more or less covered it, creating what is essentially a riskless fly. So imagine that you're unable to watch it. You take off. You don't know if price is going to keep on going up or go down, but you want to be able to potentially have access to that $3,000 of profit that's sitting in that butterfly. You could put these two trades on, and they would, in effect, gamma hedge both sides of your strategy, your butterfly, and lock in that $300, or at least transfer it to your butterfly strategy. So now the worst that could ever happen is that you end up at zero, right? So that's what the riskless butterfly was all about. That was clickbait to get you in to watch what I'm explaining right now. But had you put on just the synthetic short, that would have been a very effective hedge for the downside. So that's another very good point. So that way you can not really worry about it. Now, truth be told, what I would have done had I not put on this gamma hedge and demonstrated this, I would have, as soon as price started to move out of my profit zone, I would have taken that profit. And while I was up as much as $500 at one point, I wouldn't have allowed it to go more than $300 of profit. I would have been out of that trade, and I would have secured it, and everything would have been cool. As it stands now, I'm down $49. So all for the good of the team. However, the let's see, hold on, go back to the head. However, the P&L and the performance of our reference account is actually doing quite well. And I don't know if you saw the report that I did yesterday. This strategy that we're doing here and all of the process that we go through is quite effective. So maybe I'll show you that. Hold on. See, I took one for the team today. There we go. So this is the profit curve of my reference account after almost 200 trades, 196 trades. So far last year or the year before starting this one, I had almost an equal number of trades. The profit was actually a little bit better with that, but in total dollars, it wasn't as much, but it was a higher return, a percent return. So far after 2 years, we've had nothing but really good profit in this strategy. Now, I say let me just be clear. I have had nothing but good returns in this. And you could probably say that that's true because I am a practiced professional trader and I know what I'm doing and I institute the process. Hence, that's what this strategy is all about. Now, there are a lot of traders that are doing fantastic, others that are coming in new that have just had tough luck with their trading and are looking for a strategy and a process like this so that they can learn how to achieve that kind of performance. And so that's what this strategy is all about. All right, so let's get back to what this show is all about, and that is gamma hedging. Let's see, we do have a question from Charles. He says, with XSP, could you short one contract of MES? With XSP, short one. Well, the problem with that is that they're both the same size. And it would be, and the MES is highly leveraged. Actually, they're not even quite the same size. MES would be about half the size. No, actually, it's about 5 times the size of the XSP. So no, that wouldn't work. That definitely wouldn't work. They are completely the wrong ratio in terms of their total margin. So unfortunately, that wouldn't work. See, Rob says, what strikes do you choose for the synthetic position? I typically would choose the at the money, but it doesn't matter that much. I mean, you could choose a little bit below, a little bit above. You're going to get approximately the same result. See, Nino says, impressive performance, Ernie. I know why you trade SPX and the risk to trade SPY, but it would be possible. Would it be possible to trade the flies on SPY? No, when you can't do it on SPX. The answer is no, and there's a good reason for that. So the options on SPY are American-style options. And what that means is that they are subject to assignment and early assignment. So in other words, when you're near the end of the day and if your strategy is in the money or even close to in the money, you could get assigned and get kicked out of your position, get assigned stock, and then totally ruin your position. Now with the SPX, because it's European style options, there is no early assignment. There's no assignment until, and this is the same deal with the E-mini S&P futures. There's no early assignment until after expiration. So there's no chance that you'll get kicked out of your trade. So that's why you can't use SPY, right? SPY, off the table. Can't use it. And it's for the same reason you couldn't use SPY as a, well, you couldn't use options on SPY or SPY stock, short SPY stock, if you're trying to gamma hedge. It's a lot. There are a couple of reasons. There are many other reasons why you wouldn't want to do that. You know, by creating the short, synthetic short, you're also using a lot less margin. So people with small accounts, these are tricks of the trade that you could use to effectively do very sophisticated hedging with very little money. All right. All right. So, continues. Maybe instead of 0 DTE or 1 DTE, SPY butterfly just to make sure I can close the position before the. No, because you still have the assignment risk. You don't have any control over that. And not on top of that, your broker will probably kick you out of the trade anyways, because it'll flip a switch in their brokerage saying, "Oh, this person has assignment risk," and you don't even have to get assigned to get kicked out. Your broker will kick you out before you get assigned. So the answer is no. I don't know why you would want to use SPY. Why? It makes no sense. There is absolutely zero advantage to using SPY. Right? So just use the XSP and be done with it. That's what I would say. And that's what these things are here for. All right. Sorry, I didn't mean to yell at you, but there are so many people that ask about 0 DTE with SPY, and they simply don't understand the dynamics of the situation and what are the possibilities or the bad things that can happen. They just think, oh, 0 DTE, I'll do options on SPY because I love SPY. Yeah, it's much better to do it on the SPX and the XSP, even the E-mini S&P futures, even though the commissions are very high. And when you're doing, these asymmetric trades like what we're doing, those commissions are kind of meaningless because we're going for such large returns. All right. Let's see. Any other questions here? All right. Today, let's see, Philip says, today I made an order to buy a regular butterfly at 0.15, but it's come at, I don't know what you're saying, what 0.15 or 0.40 means. We have to use the vernacular, Philip, so that we can all talk together, right? Because I have no idea what 0.15 means or 0.40 in a credit. So the way we would, here, you know what? I'm going to educate all of the viewers here so that you'll know how to reference a butterfly. What's the preferred way? We'll bring up the, let's see. Yeah, we'll bring up the iPad here. Let's see, the iPad. Yep. No, that's not the iPad. That's not the iPad. Where is the iPad? Huh. It should be on camera 3, but it's not. All right. What's going on? Let's see. Maybe we can do this. Hold on. We'll bring it out like this. See what happens now. All right, we got that. Ah, there we go. There's the iPad. Y'all still with me? All right. So we'll go into Procreate. So if you have a fly, looks like this. And then you have your, here's your zero line. So this is your debit. And then your fly is made up of two spreads that has a short strike and a long strike, right? And then a width. So what we would say is, well, whatever the width is, we would say, and let's say that it is positioned at, where's the market right now? The market currently is at 41.35. We would say, I have a 30 wide fly at 41.35. And at, let's say, a debit of $3. So that's how you would say it. So you have a credit. Well, then you would say I have a 30 wide fly at whatever the credit is. But I don't know why you would use the credit. Because you're putting on an iron fly. Why would you put on an iron fly? Or are you putting on a broken wing fly? There's another question. Why would you put on a broken wing fly? But if you're putting on an iron fly for this type of trade, it's really it's probably not a great idea. It's essentially the same as a long fly. The only difference really is that you're putting on two short contracts, a short put and a short call. And essentially you're making the whole trade a lot more complex. So there's really no reason to put on an iron fly. Just put on a long put fly or a long call fly. Way simpler, easy to manage, single butterfly. You don't have to put on an iron fly. Just put on a single long fly. It's way better. All puts. Yep, you can put all puts or all calls. And it'll be exactly the same as your iron fly. So let's take a look at that. And there's something to talk about. All right. So here I have a risk graph, and I want to put on two flies. So one of them I'm going to put on is going to be an iron fly. Then the other one I'm going to put on is going to be just a regular long, I don't know, put fly. All right. They have exactly the same width. Maybe they're both, say, 10 wide. And they have the same exact debit or risk, same risk, right? What is the difference between those two flies in terms of their max profit and then the way they behave? Right? The answer is that there's zero difference between an iron fly and a long fly. Absolutely zero difference. Other than the fact that the iron fly is way more complex. You have to put on two short spreads. And in most platforms, you would actually have to put on an iron condor and then manipulate it so that the short strikes are the same, etc. Where on putting on a butterfly, it's a lot easier to put on. You're just dealing with 3 parameters, where you're putting on an iron condor, you're dealing with 4 parameters. So it's a lot easier to just put on a long put fly or a long call fly. They're exactly the same. They behave exactly the same. They cost the same. Everything about them is exactly the same. So there's really no reason to put on the iron fly. So I'm just telling that if you're in my service, don't do that. You're just making it harder on yourself. Go with the simplest solution. Easier to manage. The other question I've got, Philip, is why are you putting on just a 10 wide fly? Right? A 10 wide fly is one of the most difficult to actually derive any profit from. First of all, it doesn't even show any real profit until later in the day. Now, I can see if you put it on late in the day, that would make a difference. But our strategy is generally to put them on nice and early so that we can take advantage of the high implied volatility that happens in the morning. Thereby, you can get a much better risk to reward on your fly. And that's what it's all about, is risk to reward. So putting on a any fly, whether it's a 10 wide or a 30 wide later in the day, will generally mean that you just won't get the same risk to reward. You'll get a lesser or a more difficult to manage or less potentially profitable strategy. All right. So don't do that. Now, you may wonder, well, why? Why is that so, Ernie? Well, you're going to get some education here because I have finished talking about gamma hedging, and hopefully that's something that is interesting to you. How you can protect to the downside or to the upside simply with a synthetic short or a synthetic long. Let's also talk about the width of flies and why you want to choose a wider fly over a narrow fly. And also why you want to put it on earlier in the day rather than later in the day. All right, so let's do that. And just a second. I need to, of course, everything is like on the fly here. We'll get that. There we go. All right, let's there we go. All right. We don't need my head here. So this is a study that I did on various width flies. You can see I did 10Y across the top here, the widths, 10, 15, 20, 25, 30, 35. And what I did is I wanted to look at the premium decay or the value of that fly at the center strikes at half-hour intervals throughout the day, from 9:30 all the way to 3 o'clock. Now, with a 10-wide fly, it has no value until you start getting into the afternoon. For a 15-wide fly, it comes on kind of slow. A 20-wide is a little bit better, but the 25 and 30 and 35-wide, they have profit right out of the gate, and they're way easier to make profit sooner. So besides having way more potential profit, they also have more of it sooner. So you would have to put on a 10-wide fly, and you'd be sitting on it for hours before it even started to register a profit. That's one of the problems with putting on a 10-wide. Now, with a 30-wide, my preferred fly, you can put it on early in the morning, and you already have $220 in that center strike. So when it starts moving towards your fly, you're going to make profit right away. So even though the 30 will be more expensive, the profit will come back faster. Not only that, the growth, the rate of growth on the 30 wide is dramatically more than that on the, see, you can see it right here. The rate at which it grows is dramatically greater than the 10 wide. The 10 wide hardly even registers. So I don't know why you would even bother with a 10 wide fly. You're putting on too much risk for not enough potential gain. You have, I mean, the 15 and the 20 are way better. And you can put on a risk to reward by putting it a little bit out of the money where it won't cost you a whole lot. And your potential for profit, if it moves in your direction, is way better. Now, if it doesn't move in your direction, you can do what we call the Batman fly and put one of these on either side of you, one above the market, one below the market. And that's what we do in our service. That's our primo preferred strategy right now, is to put one above the market, one below the market. And from there, we hardly ever miss a trade. Except for today when I'm fooling around showing how to hedge gamma. But I didn't really lose anything, so it was cool. All right, back to the big head. So hopefully that was educational, Philip. And let's see here. So I've showed you gamma hedging. I've showed you asymmetric trades. I've showed you premium collection. I've showed you a study that we did on flies. I talked about, oh my God, you have gotten so much information today that you need to give this video a thumbs up right now. So the hedging is really a very valuable tool, and I'd recommend it very highly. If you wanted to protect yourself from the downside, it's really a great way to go. Then you don't have to worry about the any risk that you put on. Of course, if you put it out of the money, way out of the money, like the 1 to 9 that we do, then your risk is absolutely minimal. And, you know, hey, Philip, you're welcome. But I know that, you know, these are things that other people have told you to do in the past. And they'll tell you that, man, when you put on your short fly or your short credits, your credit spread, that money goes into your account right away. There isn't a bigger load of bullshit than that statement, that the money goes into your account. It's yours. It is not yours. It is not yours unless you realize it. In other words, the price goes in your direction and you close the trade. Unless you do that, that money never touches you, ever. Right? So this whole idea of credit spreads as them being somehow totally different from a debit spread, for instance, it's total BS. It is other so-called gurus that are somehow giving you a load of bullshit as if you own that profit right then. And it's just, you know, the market to take it away from you. It's a total line of shit. Don't listen to it. Go with the long fly, the debit fly. It is way better. It's simpler. It gives you the exact same performance, same cost, same max profit. Everything about it is the same, except that it's simpler. All right? JP Swede has a question. With Batman trade, do you narrow the spread or stick with 30 wide? No, I stay the same width. And I also stay with the same 1 to 9 risk to reward ratio. So now it's like putting on 2 trades. I have a 1 to 9 above me and a 1 to 9 below me. Now, the way I keep it at 1 to 9 is that I never allow, if price stays right in the center, that's really the only place it can hurt me, if price stays right in the center. Very rarely will price move out to the sides. Even if it moves beyond the fly, it has to go over the profit curve to get there. And I will grab profit before it ever gets outside the fly. So my only risk really is directly in between the two flies, right? So let me just show you that. I'll bring up the, there's a good discussion for the iPad. All right, so we'll bring the iPad up. And so let's say that we have two flies. First, I'll draw the risk graph. And let's say we're sitting right here at the money. And I want to put on a fly. I put one on here and here. Right? When I put that on, my profit curve will look something like this. Right? If I have a very wide fly, my profit curve will look actually different. It won't look quite like that. It'll look better. It'll look like this. So as time goes on, let's say it gets on, you're here, and price just stays right between here and here, right? And then let's say we're getting on to about 11 o'clock, 12 o'clock. Now your profit curve will look like this. It may still have profit in it if you have a wide fly. And then as time goes on, it may look like this. It will dip down like that. That's if price stays right there. If that's your only risk right here. Risk. If it goes this way, you're in profit. If it goes this way, you're in profit. So what I do is, if I never allow this to go more than 50%. Yeah, credit spreads really suck. Out of the money butterflies are the way to go. So anyways, that's really my only risk. I don't fear price going this way or this way, because it has to go over this bump, that bump, or this bump, and that means profit. So now, granted, it'll do this about 30 to 35% of the time, right? That means that the rest of the time you're in profit. So the risk is the debit. This is the risk right here. That's the debit. That's the debit of each one of these. So let's say I put on 2 flies. Right? I put on a 30 wide and a 30 wide. And each of them carry, say, $3 debit. That's my risk. Now, together, that would equal $6 of risk. But I only take 50% of it. So the max risk is only $3. So Charles wants to know, any validity in using daily expected move values? No, there is none. The daily expected moves is a statistical average. It doesn't tell you what's happening right then and there. We never use it. We only use risk to reward to figure out where to put our flies, because that will give you the actual thing that the market is pricing for those options. Only use risk to reward. Put on a 30 wide and keep the risk to 1/10 of the width. So if it's a 30 wide, put on $3 risk. If it's 20 wide, put on $2 risk or lower. When you put that on, the market will price your option and place it correctly. You don't have to look at expected move. You don't have to look at probability of touch or probability of profit or delta. All that stuff goes out. First of all those calculations are based on a faulty assumption. And that faulty assumption is that volatility and liquidity are static, which neither of those things are true. Now, volatility is usually greatest in the morning, and then it drops off during the afternoon and then dips up a little bit in the right before the close. So volatility is changing all the time. Plus, you have all of these binary events that could happen or off-the-cuff things, and your platform doesn't take any of that into consideration. So why you would use that is beyond me. It doesn't help you. Bigger expected move, the wider the Batman middle. Smaller expected move, the narrower the Batman. No, I usually just stick with whatever risk that I want to take. If I think that I can risk $300 a day on my trades, then that means I can put on a 30 wide. If I can only risk $200 a day, then I put on a 20 wide. What time of the day do you usually put the trades on? We put them on early because that's when we'll get the best price, the best risk to reward, because that's when volatility is usually at its peak, at the early part of the day, right after the market opens until about 10 o'clock, 10:30. That's when when volatility is highest. When volatility is high, that means that you can get your options cheaper. That means we can get a better risk to reward. So we put them on early. And we put on wide because wide is better than narrow. So we put them on early and we put them on wide. That gives us the maximum possible profit potential and the best risk to reward. Early and wide, period. All right? That's what you want to do. Early and wide. That's what she said. I don't know how that makes any sense. So, all right. The wife's going to be coming down in a few minutes and telling me we got to walk the dogs. So I got to get going. I want to thank everybody for showing up. Sorry about the beginning part of that. I will go in and edit that out so that beginning part is completely gone. But thanks for telling me, and thanks for hanging in there. Give this video a thumbs up. If you're not already a subscriber, subscribe now. You're going to get some great content. If you want to become a professional level trader, join the service. Try it out for 4 weeks. It'll be the most incredible experience you've ever had as a trader. You'll finally figure out the way to consistent profits. And if you follow the program, I guarantee, that's the caveat. If you follow the program, I will show you how an institution would train a newbie trader to become a professional member of their trading staff. That's what you will learn here. You will learn how to become a professional trader. That means that you will be a consistently profitable trader. You will learn techniques that you'll have for the rest of your life. And from here on in, you will be on the path to becoming a professional, consistently profitable trader. All right. I hope everyone has a nice weekend, great weekend. Peace to you all. And we'll see you on Monday. So take care.